Today is Monday, July 14th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, Mark Bowman, ADMIS Senior Market Research Analyst, and JP Steiner, ADMIS Associate Economist. And I'm starting today with Mark Bowman. Looking at the coffee market this morning, Mark, coffee prices at the grocery store have been at all-time highs of late. What effect would a 50% tariff on Brazilian coffee exports have on the coffee market?
Well, U.S. gets 33% of its coffee from Brazil, so we will see prices go up here. Suppliers will be forced to look elsewhere. Colombia is another big supplier of us, and we would probably expect U.S. demand to fall a bit if prices are higher. Likewise, these Brazilian sellers are going to have to look elsewhere. This may eventually even out as supply channels adjust, but any economies from proximity or from established marketing relationships will be lost. There's been some suggestions this would put increased pressure on ICE warehouse stocks, but only in the U.S. There are exchanged licensed warehouse stocks in New York, Virginia, New Orleans, Houston, Miami, but also Bremen, Hamburg, Antwerp, and Barcelona. And as of Friday, there were 826, almost 827,000 bags of certified stocks listed in ICE warehouse, but of those, only 43,000 were in the U.S. That's only about 5.2%. There are almost 700,000 in Antwerp alone. There were also 29,000 pending grading, with 284 listed in the U.S. That's only 1%. So there's not much of ability for exchange stocks to close that gap in supply.
And Mark, there was a Unica report on Brazilian sugar production. What were the implications of that report?
So that report covered the second half of June, and it showed both crush and production for Center-South Brazil below trade expectations. Production was 854 million tons, up from 2.45 million in the first half of the month, but down from 3.269 million a year ago. Trade was looking for 2.95 million, so a little bit below. And cumulative production now 12.249 million tons versus 14.285 million last year. So we're running about 14% behind a year ago. Still production now about 1.2% below the 5-year average, which is about the narrowest the deficit has been all year. We have had drier conditions in Brazil over the last couple of weeks, so we could see harvest and crushing activity improve for the first half of July. Brazil's harvest tends to peak during the second half of the year. Elsewhere around the world, we've had some dry conditions in India of late. That's lowered expectations for their crop a bit, but rain prospects are improving later this week and through next week. Thailand also dry recently, but opportunity for rain to resume later. There's some possibility of crop stress, but nothing looks critical yet.
Mark Soderberg, I know it's old news at this point, but how about a quick review of Friday's USDA reports? Any surprises out there?
Well, I think the biggest surprise on Friday was the bearish reaction in corn prices to what was, on the surface, supportive data from the USDA. Old crop ending stocks at 1.34 billion bushels and stocks to use at 8.7%. They were at the low end of expectations and a 4-year low. New crop stocks at 1.660 billion bushels. Yeah, 320 million bushels below the 24-25 marketing year. However, that was at the low end of expectations, and in global stocks at 272 million metric tons were below the range of guesses. The USDA did raise Brazil's corn production forecast 2 million metric tons to 132. However, well below many private estimates in the 140 to 150 million metric ton range. So to me, it's pretty clear the market is, with prices near $4, discounting higher production here in the U.S., which is, I think, a very safe bet. Higher production in Brazil, which is also a pretty safe bet, and lower yield resulting in ending stocks much closer to 2 billion bushels, which I think if that were to occur, likely see corn trade down to near that 380 level before the end of summer. But these are big ifs, and there's a lot hinges on just how big Brazil's harvest is. So far, basis levels down there are holding in remarkably strong despite the likelihood of record production. They're using more and more of the crop for ethanol production, which as they raise their blend rates from 27% to 30%. So we'll see if those basis levels hold strong as we get deeper into harvest. Right now, it's estimated at about 40%. And otherwise, really no big surprises in the wheat or soybeans either, with a lot of that data coming in line with expectations. We did, however, see big shifts in soybean oil usage here from the USDA.
Yeah, let's talk about soybean oil. Do you think the soybean oil will continue to drive the strong crush margins?
I do. The USDA raised their 25-26 crush estimate by 50 million bushels to a record 2.54 billion. I calculated spot board crush margins at $1.82 to close out last week, and that's a 9-month high. New crop margins even higher at 207. Bean oil as a percentage of product value pretty much closed right at 50% to close out last week. That's just a touch below the modern day record high of just below 51%. With the Trump administration's favorable policies on green fuel production, with feedstocks sourced from domestically, I think the USDA they were very aggressive at raising their new crop usage numbers here. 15.5 billion pounds of soybean oil is forecast being used for biofuel production. That's just over 50% of the bean oil produced here in the U.S., a record high. But to make room for that added biofuel usage, USDA slashed exports 1 billion pounds to only 700 million. Meal prices, on the other hand, continue to hang around 9-year lows with the added supply due to the higher crush. The USDA did raise domestic usage 1% and exports 4%, but in order to stimulate that higher demand, price was lowered $20 per ton on average, 290. So yes, I look for bean oil to continue to drive crush margins.
Thanks, Mark. JP, earnings seasons kick off this week. What should traders be watching for?
Yeah, so as Q2 earnings season kicks off this week, notably all major U.S. banks are set to start reporting results starting Tuesday. And that should offer some insight into the health of the financial sector, especially regarding IPO and M&A activity, credit conditions, and consumer spending. Now, this year has been marked by very high IPO activity, and we've seen a significant increase in the number of deals compared to last year. In 2025, there have been 107 IPOs, which is on pace to break last year's 150. Healthcare and technology sectors have been the most active, accounting for 58% of all deals and around 50% of the over $15.6 billion raised. Now, the increase in IPO activity could bode well for banks, as their investment banking divisions are likely to see strong revenue growth due to their role in facilitating these offerings. Moving over to the tech sector, we have a string of big tech firms such as ASML and Taiwan Semiconductor Manufacturing set to offer updates on the AI-related chip boom, which has been a major driver of equity growth over the past year. And I would pay close attention to their forward guidance and outlooks, especially when it comes to demand. Sector pick up so much news over the past couple of months when it comes to the AI and the chip race. Moving over to Netflix, Pepsi, American Express, and United Airlines are also on deck to report their earnings and outlooks, and should provide a reading on consumer demand and travel trends. And these kind of characteristics have been uncertain due to the headwinds faced by tariffs, likely pressuring travel for the middle class as things get a little bit pricier and people look to save a little bit more. However, there have been reports that travel among higher, wealthier people has picked up in recent months, actually. So big outlook on consumer spending habits there. I will also be watching to see how recent tariff announcements are affecting corporate outlooks. The second quarter included, and to an extent still does carry, a lot of tariff-related uncertainty, especially considering the steep sell-off that happened in early April. So I would expect comments about volatility and uncertainty to remain in company outlooks. The S&P 500 now appears to be comprised with businesses just with stronger earnings profiles that are better able to weather the uncertainty of tariffs, which are ultimately less sensitive to the economic cycle, all of which bolsters the case for earnings growth to remain strong. Now, analysts are expecting 5% earnings growth for the S&P this quarter, which would be the slowest pace of growth since late 2023. Looking forward, forward guidance will be crucial to pay attention to. Analysts are expecting 7.3% growth in the third quarter and 9% growth for the full year. So just a lot to look out for and to pay close attention to forward guidance and outlooks from companies.
What about key government reports? Any key economic data set to be released?
Yeah, there are several high-profile economic data releases this week, starting off with CPI inflation due Tuesday morning. CPI inflation from June is expected to tick higher to 2.6% from 2.4% a month earlier, as tariffs have likely put upward pressure on prices and as inventory from companies front-loading inventory begins to dwindle. Now, while the higher tariffs are likely to put upward pressure on core goods over the coming months, we could see housing services inflation cool off due to lower demand. Looking ahead, any cooling in the labor market is also likely to reduce pressure on prices. And notably, too, especially as the number of federal workers who took government buyouts are set to stop receiving their paychecks late September or early September. These workers are also likely to show up on unemployment claims figures when that time arrives. So just looking forward to see what is going to happen when that time comes. I would also pay close attention to May's revised inflation figure, as it will offer a more precise figure on how prices moved in May, as we have seen recent revisions to higher. If inflation comes in hot, we are likely to see bond yields tick higher and the dollar to gain some support, as it will likely cut expectations of an interest rate cut from the Fed in the near term. On the flip side, though, a soft reading combined with weaker economic activity could add to expectations of a Fed rate cut soon. I mean, that's been in the news. I'm sure everybody's hearing about and paying attention to that. Following the CPI inflation data, on Wednesday, we'll see producer price index inflation data and consuming spending figures as well. PPI data serves as sort of a pipeline inflationary reading, and markets will be closely monitoring what the data says, and especially what sectors have been most affected by tariffs. Core goods, like I mentioned earlier, are expected to see a little bit higher rise in inflation and are most likely to be affected by inflation. So core sectors I'll be keeping my eye on. Retail sales data will also offer a glimpse of how consumers are holding up in the midst of this tariff chaos. Any slowdowns or notable changes in spending figures are likely to draw strong attention from markets, as the U.S. economy is so heavily reliant on consumer spending. Industrial production figures will also be published Wednesday and are expected to show just a 0.1% growth in June over the previous month. Lastly, weekly initial jobless claims Thursday and the University of Michigan's July preliminary consumer survey on Friday will also give more of an up-to-date snapshot on consumer sentiment in the country.
Thanks, JP. Thank you all. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.